Hey, good morning, everyone.
Good morning.
Hey, good morning. Good morning. That was Victoria, right? Good morning. Just give me a second while I'm setting things up. Um,
안녕하세요. Good morning.
hey, 안녕하세요. Good morning. That was Jason,
감,
huh? How are you?
네, 네. 감사합니다.
Where did you where did you pick up some Korean greetings?
Oh, I used to go to a Korean church.
Oh, no. Well, that was a surprise. I never go to, I never go to a Korean church, or I don't. I actually, I'm not very religious, but if ever, if I'm categorized by some religion, I'm Catholic nominally, and I've I've never gone to Korean church.
Um,
Um,
it was run by Koreans. That's why.
it's what?
It's run
Run.
by Koreans.
Yeah, yeah. I mean,
Yeah.
I've noticed lots of Korean churches are actually sharing the same building. Um, they're sharing the same building, same church building. It's like I don't know how they do it. Very old, landmark churches. Oh, you think oh, that must be some old, traditional Baptist or Methodist church. And then when you approach that, then there is no Korean sign.
Yeah.
Uh, either they bought it out, or they just share the building. I mean, they pay the rent or share the building, or I don't know.
hmm
And they alternate the services, between English service and Korean service, like by different hours. But I never liked the way, especially the evangelist churches, horrible. I mean, the way they kind of, it's almost like indoctrinate. Of course, the religion is basically indoctrination, by nature.
Yeah, of course.
But then they are like too much, enforcing too much. I mean, there's no free will.
Yes, yes. I
It's
mean
like,
that's the reason why I left.
yeah, the Korean, especially the Korean evangelist churches, they are um, almost to cult level. They are so
Yes.
enforcing. And so that's
Yes,
something I don't
yes.
like about the evangelist. I think most evangelist churches are like that, by nature. Well, anyway, so in our last class, we talked about the we were talking about the word. I had opened it. How the bond prices are quoted in the print media, um, and the print media, the way they show it in the print media may be a little different from when it is shown on the online media, because when if it is the price quotes on the online media doesn't necessarily follow this 30-second system. We talked about this 30-second system last time for Treasury, right? Remember that? Hmm? Oh, maybe we haven't, because we talked about, all the prices are basically by percentage, right? Prices are quoted as percentage. And we talked about corporate bond and municipal bond last time. We left, we left this out because we were out of time already. So these are, percentage prices, and so are these. But then if you look at beta, the Treasury, right? Um, they quote two prices, two different types, bid and ask. So bid and ask is quite obvious, right? If you ever bought something, on eBay, you would know what is bid and what is ask. Bid is the price that the buyers are willing to pay. Ask is the price that the sellers sellers want. So then, how does the transaction then, you might wonder if the bid and ask price, there's a difference between bid and ask price. How can the transaction happen? Well, of course, there are bond dealers. Dealers are different from brokers. Dealers have higher brokers too, but dealers are basically the ones who are making money by brokering the deal between the buyers and sellers. And dealers dealers do have their own positions, meaning they have their own investment, and then they are basically market makers. They trade for their own profit. So the dealers, close this gap. They come into play, between the bid and ask price. But what's more, curious here is, okay, if the price is a percentage, that looks like 104%, 104. But what's after the colon, right? The colon. Why isn't it 104.25? Why is it 104:25? Well, what that means, so it's not, it's 104% right. It's correct, 104%. And then behind the colon, that means, not 0.25%, but it means 25 over 32 of 1%. 25 over 32 of 1%. Okay, so it's a 30-second system.
What's going on?
I'm sorry.
Sound cut out for a second.
Yeah. That was sorry. I had to. There was always some distraction.
It's never a dull moment. That's the challenge of online class.
Well, it's a good thing if there's, you don't have any dull moments. There were, things that always, these alerts popping up, alerts on the phone popping up as if it is, some emergency. Sorry about that. So where was I? I said 30-second system, right? So what does that mean? Look, it's basically 25 over 32 of 1%. So it's 104% and 25 over 32. So then how do you calculate that? Of course, it's not a difficult thing. A bid of 104:25, that means, $1,000 times 104%, and 25 over 32%, right? We can easily, convert it into just, regular decimals, and it comes to $1,047.81. Okay, by the same analogy, right, or by the same method, you can convert 104:26 into the dollar price, comes to $1,048.13. There's just about not even $1 difference. That's very close, but suppose the dealers are executing orders, lots. Lot means 100. I mean, it's especially if this is a if this is stock transactions, stock trades are executed by lots. Lot means 100 shares. Of course, there are odd lots. Odd lots means the orders that are less than 100. But then the brokers gather or collect the odd lots and make up a bundle of even lots. But dealers in the bond market, bond dealers would do the same. They bundle up the odd number orders into even lots. And then if it is like 100, one lot, that's 100, order of 100 bonds, right? Order to buy or sell 100 lots. Maybe 10 lots, that's 1,000. Then think about it. $1 difference per bond would mean $1,000, right? For like 10 lots. So it's going to be a huge amount when they trade in a large volume. So anyway, the point is, yeah, we can easily convert that into a dollar price. But then, where did that 30-second system come from? The 30-second system. So let me show you where that 30-second system came from. Whiteboard. Okay, I don't know. Oh. This one. No, not this one. You see, if you so if you have a car, or if you ever drove a car or rented a car, you would know that the fuel gauge in the dashboard would look like this. The fuel gauge in the dashboard will look like this. Excuse me a second. I'm kidding. There's constant email alerts. And you must have noticed that of course the fuel gauge would have like full and empty, right? On one end you have full, the other end you have empty, and then it's cut into like split into 4 quarters, right? First half, and there you see 3 quarters, and the bottom 1 quarter, right? And then if you split it again, by 2 again, then it's going to be 7/8. It will be by 1/8. Every notch will represent 1/8. Split it again. Split it into 2 again. then it's going to be 1/16. Split it again, it's going to be 1/32. But then you might wonder, why did they use, this inconvenient, uh, less intuitive system? It may not seem very intuitive these days by today's standards, but by like 18th century standards, this was, quite convenient. Now, you may think, stock market is only like 20th century legacy. No, stock market has been around pretty much since the modern ages. Modern ages doesn't mean, like 20th century. Modern means like, almost like, after the Renaissance period, like, as people got more, people as people started to pursue the reason, right? Reasoning ability, the rationality, right? So a lot of enlightenment was, brought into the society. I would say modern age, began with like Newton, Isaac Newton, and like French mathematicians and philosophers like René Descartes and Pascal and people like this, because they basically question why does it have to be this way, why, and then they refused, the they refused the they refused the state being run by the church. In other words, they pursued secularization. Secularization means, separation between church and state. Um, and that's also about the time when the mercantilism, flourished. And so around 17th centuries, right? 17th century, there was stock market in Amsterdam, and you might wonder how. Well, the stock market started out, it's nothing, but it started from funding the international trade. In those days, it was maritime trade, because the European society in those days, wanted all these spice. They knew there were spices and silk from the east. So, but then, since the land road, the land road was very dangerous, because it was through the during the Roman times, there was something called Silk Road, but the Silk Road was through the deserts and very arid, dry areas, through the very, steep mountains, and and constantly plagued by the bandits, right? So the land route was very dangerous, and then that route was, basically leading to China, and between, China and Roman Empire, there was, frequent, trade. And then around 16th, 17th century, they used, maritime route, and then they arrived at India, and from India um, um, they bought, spices and brought it to Europe, and from Europe, whatever they could sell to India, they took it there. I mean, the reason Christopher Columbus set out for sailed to find the path to India was by sailing west. It was because of mercantilism, mercantilism, um, mercantile activities. So because if they sailed to in India and whatever they um, the ship won't leave empty, right? They will they will load the ship with the cargo of the West, in those days, and uh, take it to India, and from India they sell it, and then with the revenue or the proceeds, then they buy spices, and then bring it to Amsterdam, and they sell it uh, in the West. So basically, they made there were wealthy people, aristocrats, mainly in those days, aristocrats and wealthy merchants. They funded they funded this ship. Think about it. It's gonna be a huge venture, and then so basically, think about it. The things that they are gonna sell in India in those days, the merchandise, uh, they basically fund the purchase of these goods, and then they uh, load it on the ship, and then they fund this trip. Somebody has to pay the captain and the crew, right? Somebody has to pay for the supplies for this trip. And then when the ship comes back, the booties, or the bounties, or the booties, or um, uh, the profit from the boon from the sale of the spice from the east. They have their, they take their share, right? So basically, funding these, trips to trade trips to east, um, was, funding for that was raised through the stock market, and basically, you pay for it in shares, in a percentage, so that's how the stock market developed, even in the 17th century. And then think about it. In those days, what was there in news media? No, there wasn't any news media. The news was basically word of mouth, right? And how do they? And then the stock market participants were wealthy merchants who generally lived in the cities, but the wealthy aristocrats, they didn't live in the cities. They lived in the countryside because they have the estate. They had their estate, their land, their manor, and then um, they inherited it from their ancestors. Even during from the feudal ages, Middle Ages, feudal system, right? The king gave them the estate to the knights and uh, the aristocrats. In those days, uh, dukes, earls, counts, things like that. Barons, So aristocrats lived in the countryside, and they had, a lot, a big chunk of their wealth invested in the stock market. So they need to get the news, and even if there was, a printed newspaper, but barely, around like 18th century. Remember, Benjamin Franklin in the 1700s, he had newspaper. He had a printing press, and he printed newspapers, but that had a very limited circulation. Think about it. In those days, newspapers were mainly geographically limited. Uh, if it is only like Pittsburgh or Philadelphia only, I mean, the newspaper of Philadelphia cannot travel to um, within the day. It cannot travel to New York City or Savannah, Georgia, or think about it. That's newspapers were limited. It's just local, right? And if it travels to the countryside, it's gonna take uh, many days. It's gonna take many days. It's gonna be like, and it's gonna travel by the messenger on a horse riding messenger, right? It's gonna be uh, carried on a horse riding messenger. So it's gonna take many days. So it's not gonna be on news anymore. By the time it reaches the countryside, it's not gonna be on news anymore, right? So, but then they needed this information. Then in those days, people were generally illiterate. Literacy level wasn't that high because there was no public education in those days. Most of the peasants, right? It would be either aristocrats or peasants, um, and some city dwellers, who are either wealthy merchants or uh, uh, then people who are working for these the word bourgeoisie, the word bourgeoisie, that comes from the word uh, like bourg, right? Like Strasbourg, bourg, right? That means a city walled, city confined in the walled uh, in the wall, right? Um, so people who dwell in that city, like fortified by the wall, are so-called bourgeois, right? Bourgeois. And then bourgeois were uh, independent, wealthy, and educated. So they were literate. They were the only people that could stand against the aristocrats. Later, of course, that's how the all this democracy uh, came about. Um, they were because they were wealthy, they could stand against the aristocrats and clergy, and even the king. Um, but then, in the cities, it's either wealthy merchants or the people who worked for the wealthy merchants, or um, so anyway, uh, because the literacy level was not that high, then it's not easy to keep track of all those, there were, like stocks in the stock market, and keeping track of all those, prices, and, the name of the company, the name of the vessels in those days, vessels that leave for India, March 7th, or these things, um, keeping accurate record of those things were not very easy, and the carriers, the messengers, had to leave, probably, every day. And in those days, price movements were not that frequent as these days. Obviously, how do you know? I mean, the ship hasn't sailed yet, and if the ship sails, then you have no way of knowing where the ship is, what happened to the ship, whether it ran into a storm, or whether it met ran into pirates, or no one knows, right? So price movements were not that frequent. So there was no reason to make it complicated. They just tried to keep it simple. So they used, 1/8 system, and 1/8 system, with the needs, over time, it developed into a 1/16 and 1/32 system, right? So that's like the background history of uh, the 1/32 system, and uh, I would say, pretty much, Treasury has still, is keeping the legacy of this, 32nd system. But as long as you can translate that into the dollars, that's not uh, a big deal. So back to so we kind of digressed too much. What's the time now? What time? Um, what is wrong? My clock isn't showing. Okay, I guess it's correct. It's like 35, 11:35. So now we know. And then let's take a look at the last column, or the fifth column. Fifth last column shows yield. Yield, right? And then what is yield? And I've been telling you over and over, yield is another name for rate of return, annualized rate of return, right? Here, the yield, so it's different from coupon rate. Why? Because coupon is only the interest, right? Yield is not only the interest, but also it includes, capital gains or capital loss. Okay, so remember, I hope you would remember our example from the first topic, right? Okay, so do you remember this? This is the house value example, right? And in this house value example, there are two scenarios. You remember that? Two scenarios, right? Scenario one is where you buy the house and use it as your residence. Okay. Scenario two is where you buy the house and rent it out. Now, in scenario one, there is only one source of cash flow, which is capital gains, right? Because you live in that house, and over time, over this 11 years, um, if you sell the house value will change, and by the end of 2016, if you sell the house, then you will realize the capital gain of 350K, right? Because the house value uh, started from this when you bought it, and then it ended up with this. And there was another 350K. And that's the only source of cash flow for you, right? Because during this time, the capital gains was the only thing. But if you rent it out, there are two sources of cash flow. One, of course, capital gains. Second, the rent. Isn't it right? The rental income. That's the second source of cash flow. So under these two scenarios, holding period returns are different. Holding period return in scenario one is 233%, but under scenario two is 347%, right? Obviously, because you'll be dividing under scenario one, you'll be dividing only capital gains by this. But in scenario two, you're dividing, right, these two, right, by the initial investment. And then that's holding period return, not the annualized return. Now, if we find the returns on the scenario, this is scenario one, on the scenario one, annual returns, in other words, year to year return, year by year. In the first year, this was the return. Second year, this, right? Annually, these were, and in scenario two, these are annual returns. So if we, take the average of those, and I told you, it's not the simple average. We have to take the weighted average. We have to take the geometric average because of the compounding effect. We come to the geometric average of these, and these are yield, basically. But then, as I said, in this case, this is column E is scenario 1, and in scenario 1, the yield the yield is exactly, or the annualized return is exactly the growth rate of the house value, because there's nothing else. There's no other source of cash flow. But in scenario 2, you have two components. The yield comes from two components. So if you're looking at scenario 1 from scenario 2, the return in the scenario 1 is nothing but growth rate, right? But the growth rate in scenario 1 is also yield in the scenario 1. But in scenario 2, yield in scenario 1 is nothing but just the growth rate. And this is the true yield. Okay? And again, so yield is another name for annualized return. And then bond is exactly like scenario 2, if you think about it. Isn't that right? Because bonds have, basically you will have capital gains or capital loss at the end, right? Because when you at maturity, you will get paid. At maturity, you get your money back. In other words, you get $1,000. I mean, you present it to the issuer, you get 1,000, right? And the final interest, right? And in the meantime, so it's like, capital gains, because when you bought the bond, think about it, in the CIT, corporate bond case, if you bought it at this price, right, which is $917.35, and at maturity you will get 1,000, so there will be a capital gain of like almost $83, right? There will be a capital gain of $83, and for 6 years you will get interest payment of $70 a year for 6 years, right? So it's exactly like this, right? There will be a capital gains over 6 years, right? Capital gain over 6 years, and then interest payment over 6 years. Of course, in this case, and the interest payment is annuity because it's always the same thing, $70 every year. Now, in this case, the rent increased, but rent is basically rent is constant, right? Unless the landlord raises the rent, right? And the landlord cannot just raise the rent, at random, right? They cannot randomly raise the rent. It will have to, I believe, by law, it cannot go up for 2 years at least. And if you live in a rent-controlled building, then the rent can go up, but without the approval by the city, right? And first it will have to be negotiated with the tenants, and then it has to get approved by the city. So they cannot just raise rent at their own will at and also they cannot just raise it at random, right? So scenario 2 is pretty much like the bond. Okay. So that's how the yield is, and I will show you how the yield is calculated later. But take a look at this. In the corporate bond, in this corporate bond example, coupon interest rate is only 7%, but the yield is 8.838. So yield is greater than, and also in the municipal bond case, yield is also greater than the coupon interest rate. But in case of treasury, yield is much lower than coupon rate. It's like 0.89, almost tenfold difference between the corporate with the from the corporate bond. Tenfold difference from the corporate bond. And why is the yield so low? In case of treasury, and think about it. You can tell already from this. The prices. Can anyone answer this? So is the treasury a premium bond or a discount bond? Anyone? Premium bond, yes. And
Jason,
who was
come on,
that?
Joe. That was
Okay,
me, Jason.
Yeah, Jason, okay. You got, 0.25. Yeah, it's a premium bond. Now, what about the corporate bond? Is it premium bond or discount bond?
Discount bond.
Discount, yes.
Jason again.
Okay, 0.25. Another 0.2. And what about the municipal bond? Is it a premium or discount bond? Premium bond or discount bond?
I believe premium.
No, it's a discount bond. Look,
okay.
Price is, is percentage of the face value. As long as the percentage is not, if it is 100, that means it's face value or par value. It's selling at par value, but it's below face value, right? Below anything under 100%, that means it's selling below the face value. So it's the discount bond too. It's a discount bond. But then think about it. Discount bond is selling below par value or maturity value or face value, and at maturity you get 1,000, right? You get the par value. And in case of municipal bond, I told you the par value is 5,000. Anyway, you get 5,000, but if you're buying it now, the price is like 4,000 something. Also, this one, if you're buying it now, $917.35, and at maturity you'll get 1,000, right? Then all the discount bond over the life of during the lifetime of the bond, will there be capital gain or capital loss?
Say that again, Professor.
Okay, over the life of the discount bond, will there be capital gain or capital loss?
If it's a discount bond, I would say a capital loss. No, not capital loss, capital gain.
Well, look, I'm sorry, there is no point there because there's no point. No point can be given there because it's either A
That's
or
okay.
B. It's either A or B. So if A is not correct, then the answer will be B. So look, There can be capital gains. There's capital gains over the life of the discount bond. Why? Think about it. By definition, discount bond, this is maturity. Why is it time t, right? And this is time 0. Now you're buying the bond at this point, and the price is what? 900 something, $917, right? And then 6 years later, so in terms of dollar value, it's 917 here. 6 years later, at maturity, par value of 1,000. It will be 1,000 here at this time. Then what's going to happen? What do you see here? The price of the bond will rise like this over time. Isn't that right? And what is this? That's capital gains. You pay 917 now, 6 years later at maturity you get 1,000. This difference is called what? That's capital gains. What else can it be? Huh? Right? Now, on the other hand, then not this. What is that? Then look at the Treasury. Treasury, is this a discount bond or premium bond? Treasury. Is this a discount bond or premium bond?
Oh boy.
Jason, didn't I ask this question already?
I believe you did.
Yeah, and then didn't you answer this? Because you got two correct answers.
Yes.
You got this right, but you got this wrong. But then
Yeah.
where did you get that, another 0.25 from? I believe you got it from. Well, if you answered it correctly, why can't you answer it correctly? Why can't you answer it now?
Sorry. Look, what did I say before? Oh my gosh. All right. Sorry.
Look, what is this? I mean, we already know how to turn this into dollar price, right? Don't we? And I already explained this. And if by multiplying it by, I mean, by definition, 104 is what? 104%, right? That's 104% and 25 over 32 of 1%, right? By definition, this makes it already greater than the par value.
Which is
I mean,
premium.
other than Jason, what's other people doing? Other than Jason, nobody's listening.
Come on, guys. You have to respond, guys.
Other people. What about other people? Other people are just props? Huh? What's going on with the other people? Huh? Alisa,
I
are
don't
you
know.
there?
Listening, Professor.
Cora, you're there. But how come other people are saying nothing? As if you're just being, props. Huh? Alisa, are you there, Alisa?
Yes.
Okay, you're there, but how come you're being so quiet? How about you, Felicia? Felicia, are you there? Felicia, you're being so quiet. Jared, are you there? Jared? Okay, Jared is, I think, prefers to be a prop. Michelle, are you there, Michelle? Nolvia, you're there, right? I can
Yes.
see. Michelle, you're there. Jordan just joined. Oh, where's Jordan? Jordan, are you there, Jordan?
I'm here, Professor. I was having Wi-Fi issues.
Okay. And I was just checking because the rest of the class is so quiet. Victoria, are you there, Victoria?
Yep.
Victoria? Okay. Oh, you're there. So make some noise, please. Make some noise. Um, Not the background noise, but make some legitimate noise, please. Now, look, we all know that this means, already 104%. I mean, forget that you forgot what this colon 25 means, but it's already, by looking at this 104, that's already, 104%. Then the price is above 1,000, the par value. Then is that a premium bond or a discount bond?
Like I originally said, I said premium for that.
Yeah, it's a premium bond. Yes, of course. And in the slide, it clearly tells you uh, if we numbers after colon represent 30 seconds of 1%. So if you convert it into dollars, it comes to 1,047. So then, what can you say? If you buy it today, the price is like something like here, right? 1,040, 1,047 something. And then from that price, 3 years later, it will be just 1,000. Then what's happening in the over the life of over the life of this bond? What's happening? Huh? What's happening over the life of this bond? That's called capital loss. Isn't that right? You paid 1,047, but you're getting only $1,000 back,
You
right?
just lost $47.
Yes. Where is the other zero? I guess it's hiding some. Yeah, 1,000. You're only getting $1,000 back. There was a capital loss of $47. In this case, there's a capital gain of something like $83. Think about it. So this, and then for this corporate bond, you have interest payment of $70, right? Interest payment of this capital gains plus cash flow, sum of all the cash flow. That's all this cash flow is, basically uh, $70 a year for 6 years, right? And then for this treasury, there's a capital loss of $47 and uh, sum of cash flows, in other words, interest payment, which is, what, like $27.50 a year for just about 2 years, only about. So that will be only like, $55. That will be only about $55. And then, there's a capital loss of 47. Uh, Still, it's positive. Still, the net proceeds or the net return is positive, but still, for paying $1,047, then think about it. The That figures, that makes sense. That figures why the yield is this low. It's not even 1%. But in case of, this corporate bond, it explains why the yield is this high, right? There's, $420 over 6 years, in interest payment, and capital gains of like $83. No wonder yield is this high. Okay, that's the yield. Okay, so this is basically how it is reported in the print media, how the bond price is quoted and reported in the print media. Okay, next, municipal bond. Here's the we need to talk about tips and the municipal bond, but let me go to the municipal bond first. And I told you already, municipal bond has the face value of $5,000. So it's not easy for any individual investor to buy municipal bonds, because if I have $5,000 and if I have $5,000, I can buy about 5 corporate bonds or treasury bonds, right? With $5,000, I can buy about 5 of them, and this makes my position, or my investment position, my bond holdings, more liquid. Meaning, what does that mean? Meaning, I can, if I need $2,000 quick, I need $2,000 quick. What do? I can sell 2 of my bonds. And turn it into it will be more. It may not be exactly 2,000, but depending on the selling price at the time, the present value of the bond at the time, it could be.
Pretty much you're liquidating everything that you have.
Say that again.
I said pretty much you're liquidating everything that that you can get out of that bond.
No, not everything. I said you have.
Not everything, just part of it, partial.
Yeah. You can just liquidate just part of it, right? And then keep the rest in the bond. Keep $3,000 still in the bond, and make it and still make it work for you. You can still collect $70 interest every year, right? From those 3 bonds. So that will be at least $210 a year from 3 bonds, right? Every year. And you can conveniently liquidate. When you need cash quickly. You can conveniently liquidate just a part of your bond holdings, right? But if you put $5,000 into a municipal bond, you can buy only 1, and then you need $2,000 quick. You cannot liquidate partially. You'll have to liquidate the entire thing. You'll have to sell the entire corporate bond, the municipal bond. Once you sell it, then you won't get that 4.5% interest anymore, right? So this is this is a burden. Think about it. If I have $5,000, to which bond will I put my money in? Obviously, you won't put your money into the municipal bond because of that low liquidity, right? And also, when the coupon rate is this different, right? I wouldn't deliberately put my money into this. Does it make sense? Why would I put my money into a bond that's illiquid or less liquid, and then that pays lower coupon interest, right? No rational person will do that. Okay. But then, what is the so mostly it's the institutional investor. It's the institutional investors that invest in the municipal bonds, because muni bonds, the cities like New York City, right? Municipalities like New York City, and look at the agency that sold this bond, New York City Municipal Water Finance Authority. So New York City sold this bond, and the chances of New York City going bankrupt is very low. New York's think about it. All the municipal governments, city governments, state governments, they also have different default risks or credit scores. And the financial center, like New York City, is the highest in the credit rating. And after New York City government, then it will be London. I mean, London used to be the number one world, financial center before World War II. And after the World War II, it moved to the New York City, but London is still like I would say almost as big as New York as a financial center. And then after London, it would be like Shanghai, Hong Kong, or Shanghai. And then after that it will be Tokyo. And then after that it will be Frankfurt, Germany. And then after that it will be like Paris. After that maybe Zurich or Paris, Switzerland, or Paris. And then after that it would be Milan, Italy. These financial centers of the world, they will hardly go bankrupt, right? And then insurance companies, institutional investors like insurance companies, they have huge cash flow. What do they do with that? They will have to put it into a long-term investment that can give them steady, long-term, sustained, long-term, steady cash flow, right? And what better instruments are there than New York City municipal bonds? I mean, they can put the money in the treasury, but treasury treasury yield is very low. Treasury yield is very low, so they will put more of the money into New York City municipal bond, right? Makes sense. And on top of that, the muni bonds, the advantage of muni bonds are that they are tax exempt. Federal income state taxes, they are exempt, and also from New York City, at least within the state where that bond was issued, it's tax exempt. So that gives a big advantage, right? And if you have a lot of money, right? And think about it, insurance companies, the payout from the insurance companies cannot exceed the pay-ins. If payout exceeds, then they won't be in insurance business, right? Isn't that right? Does it make sense? Insurance companies, their cash outflows are less than their cash inflows. So they have a lot of money. They are sitting on a lot of money. What do? They will have to put it into something like fixed, safe, fixed income instruments like municipal bonds. And municipal bonds are tax exempt. That's an important aspect. So it's already 12:07. So I think it's a good time to take a break. And when we are back from the break, we're going to be discussing further about why it is, how that tax exemption works. Okay, so we'll take 10 minutes and come back at like 12:18, 12:07, so like 12:17 to 12:18. Okay, all right, 10 minutes. 10 minutes. All right, we're back. Oh, what's going on, Mark?
What's going on over there?
Okay, I'm using another computer to log in as a preview user, and then I think these two computers are interfering with each other. Oh, okay. So maybe I should. This is not good. All right, all right, sorry about that. Um, all right, let me just make there's no background noise now, right? Okay. So now the muni bond,
No,
right?
Professor.
Okay, good, good. Thank you. Um, yeah, muni bonds. As I said, they are tax exempt. This is a big advantage of muni bond, and that's why the institutional investors, like big insurance companies, are uh, mostly the investors in muni bonds. But you know, so you might think, oh, I should, as I said, between this corporate bond and muni bonds, you might think, oh, I'll get this because it's 7%. The coupon interest is 7%, and this one is only 4.5. So this clearly wins out. You think, no, but that you need also to consider that this is tax free. That means the interest paid by this muni bonds are tax free, whereas this one is subject to taxation. So let's take a look at this example. Investor compares after-tax interest income earned on taxable bonds against return on muni bonds. So you need to compare the after-tax income from the corporate bond, right? And corporate bonds are taxable. Treasury also, so is Treasury. It's also taxable. So investor in 35% marginal income tax bracket has $100,000 to invest in either corporate or muni bonds. Now, a marginal tax rate, you must remember this from chapter 2, connect chapter 2, chapter 2 problems. There was a lot of in connect chapter 2 end of the chapter problems. There were a lot of questions about tax, and so at that time you learned what marginal tax rate means. Marginal tax rate is what is the tax rate if you make one more dollar. If you make one more dollar than the one more dollar, what tax rate will it be taxed at? Right? That's marginal tax rate. So think about it. If your top tax rate is 32%, 35%, and of course, to fall into 35% top tax bracket, you must be making almost like $200,000 a year. But otherwise, the top tax bracket would be like 32%. But anyway, I just want to the way the personal income tax works is that you're not paying at your top tax rate. For example, let's say your taxable income let's say your taxable income is 100K. Okay. Another name for taxable income is EBT. Don't forget, right? Earnings before taxes, right? But that's, for corporate, for individuals, you don't call it earnings EBT, but it's the same concept. And then you will have multiple tax brackets, right? Between zero tax brackets, 0 to 15K and 15K to like 35K, between 35K and 70K. And between
I got a question.
Yeah.
Is earnings before taxes another way of saying gross or something like that?
No. Gross is think about it. Gross is before subtracting anything, right? So gross is the term that is used only for like gross income.
Got it.
Gross income is your income before subtracting any exemptions or
Expenses,
deductions,
yes.
right?
Got it.
And then so it's basically your total gross income, and there is also something like gross profit. But I've been telling you, well, when we were doing that topic, I've been telling you gross profit is so useless line item. I mean, because you're not really at profit when you say gross profit. It's only subtracting only CGS.
Got
Only
it.
after subtracting CGS, then you call it gross profit. But so that's not really profit, because you must also subtract the operating expenses too,
Right.
right? So now these are tax brackets, and then the tax rates. Then up to this 0%, and then between this let's say 15%, between this let's say 25%, 18%, let's say, and between this 25%, maybe I may. If you have, so you might think, oh, because if my taxable income is, since my taxable income is 100K, I must be paying 25% of my 100K. No, this was what we did in chapter 2. You don't pay, you don't pay, at top tax rate. you go through every bracket. So for example, for your first $15,000, you don't pay 0%. But for 15 to 35, so that's like 20K. For that 20K, you pay 15%. And after that, 35 to 7, that's 35K. For that 35K, you pay 18%. And then between 70 to 100, that's 30K. For 30K, you pay 25%. So you go through every tax bracket, right? And so effective total tax rate is much lower than or average tax rate is effective tax rate or average tax rate is much lower than your top tax rate, actually. And then if you make one more dollar, then you will fall to the next. If you make one more dollar, you will fall into the next tax bracket, which is, then between 101, actually, 101, so let's say 150K. Let's say for this bracket, you're paying 32%. Then if you make one more dollar, currently, and I want you to pay attention because a lot of people are completely, disengaged. And then when I ask something, they don't know what's going on. But if you're paying attention even for, 30 minutes is your attention. If your attention span is, even for 30 minutes, then you wouldn't be losing. You wouldn't be losing the focus. Most of the times, the problem is your attention span is no more than 30 seconds. That's the problem. 30-second attention span is just like goldfish. Huh? If you have very short attention span, that's like a child with temper tantrum. An adult would have a decent attention span. An adult would have more patience, right? That's an adult. If you have an attention span of a child with a temper tantrum, right? Just I'm sorry, but there's nothing that can help you. I mean, college class isn't for you if you have an attention span of a temper tantrum child. So if you're paying attention, you're in the flow, and you would know our assumption is that your taxable income is 100K. So then you go through these tax brackets. But if you make one more dollar, that means your taxable income is 100,001. And then $1, that next $1 will fall into this bracket. So 32% of that $1 will be taxed. 32%. So out of $1, 32 cents will be the tax. That's what is meant by marginal tax bracket. So that means if your taxable income is not 100K, let's say if your taxable income is 90K, let's say your taxable income is 90K. And if you make one more dollar, then what does that mean? If you make one more dollar, you will still be here. Your taxable, your marginal
It'll be
tax
under
rate,
the 25%.
yeah, it will still
bracket.
be 25%. If you make one more dollar, still, I mean, until you make another 10K, right? Until you make another 10K, your marginal tax rate will still be 25%. You understand? That's what is meant by marginal tax rate. And we're running out of time, so I'm going to have to. So that means if your marginal income tax bracket is 35%, then whatever you make beyond, whatever you make beyond your current income, you'll be taxed at 35%. So the interest from the corporate bond will be taxed at 35% because that's additional income to your current income. So it will be taxed at marginal tax rate. So if you invested in a corporate bond, which pays 7% coupon, right? 7% coupon. So your interest income will be $7,000, right? 7% of 100,000, right? 7% of 100K, right? But you have to pay taxes on this. If you put it into the municipal bond, let's say municipal bond pays 5%, it will be $5,000, right? But this is tax-free. So then we need to adjust the corporate bond income, right? The interest income from corporate bond for tax. So 7,000 times 1 minus 0.35, because 0.35 is the tax rate, right? So the rest of it, 0.65, 65% will be the retained income from this interest, which will come to 4,550. So in that case, the muni bond wins out because muni bond is 5,000 tax-free, right? And in our example, muni bond pays 5%. But think about it. If between these two, actually, it's 4.5%, right? It's not 4.5. It's not 5%. If it is 4.5%, it will be pretty much, it's 4,500, right? Your, oh, no. It's not 4,500, but, if it is 1,000, if the face value of, it will still be 4,500, because anyway, the money you have is 100K. You put it into the 100K, you put it into the muni bonds. You'll have 20. You can buy 20 of them. From 20 of them, anyway, the 4.5% of 100,000 will still be 4,500. If it is 4,500, if it is 4,500, where am I? If it is 4,500 from the muni bond, still the corporate bond will win. It will win out because even after taxes, it will be 4,550. So still $50 more. But if muni bonds interest rate is 5%, clearly the winner is the muni bond, right? Makes sense? So think about it. What I did here is, did I do it here? Maybe not this, no, not this one, but then this one. Okay. So look, after-tax interest income from corporate bond, right? After-tax interest income from corporate bond. That's already mouthful, isn't that right? That's why I don't like verbiage. That's why I don't like wordiness, because it's mouthful. It's tiring. I mean, I get exhausted saying these things. I mean, 2 hours, the class runs for 2 hours, and it's like I'm giving a rock concert for 2 hours, and I get really tired. I get tongue-tied. I can barely speak after 2 hours. But using math, this whole thing is, look, what is this? 1 minus tau c. Tau is Greek character for t, so that means tax rate. What's the subscript c? That's corporate tax rate. 1 minus corporate tax rate. That will then, it will give you what is left after paying taxes. Isn't it right? So times interest interest from corporate bond. That C means corporate, right? So what does this mean? That means after tax interest income from corporate bond. So how concise and efficient and how time saving it is to put it this way, to talk like this. Talking like this is like elementary school. You understand? If you have to, if you understand only if you are told like this, then that's elementary school. If you're a mature person, if you're an adult, you should easily understand this and you should speak like this. This is exactly 1 minus tax rate times interest income, right? Then that's what? That is, interest income from municipal bond. That's like equivalent to muni bond interest. Okay, that's what we did exactly in that calculation. And again, if you solve this for corporate bond interest, solve this equation for corporate interest, it's exactly x times y equals z structure. And if you want to know what's x, then you divide z by y. So then you do this interest. If you already know the interest from the muni bond, it's taxable bond equivalent, right? Interest income from the corporate bond, that's equivalent to muni bond, right? So taxable equivalent to the muni bond can be calculated this way, right? Does that make sense? And if we are, and this is the dollar values, right? If you do this gives you dollar values, right? But if we turn it into percentage, right? If you know the muni bond yield, right? If you know the muni bond yield, if you want to know how to convert that into its taxable equivalent yield, right? Taxable equivalent yield, which is, corporate bond yield, simply the same thing. You must adjust it by 1 minus tax rate. Okay, that's what it is shown here. So the same thing, but just solved for the other variable, right? Okay, this equation is exactly that equation, and you can see how it came about, because we got the equivalent, right? All right, we're already out of time. It's already 12:42, so we should call it a day. Any questions so far? Is there any questions? Any questions? I guess no, right? You're Jason. You don't have to sigh as if you carry the burden. So I would take it as no. So I will see you guys on today's Wednesday. So next Monday, I'll see you next Monday, and have a great afternoon.
All right, see you next week, Professor. Have a good one.
All righty, you too. Take care, everyone. So I'm gonna stop sharing. Stop